They say that small to medium-sized businesses are the backbone of the economy, and Lending Club was one of the first that kind of stood up in 2006 to support them with that service. And things have changed in the past 8 years. There's now a lot more competition in the space. So we're going to bring out Leena Rao to talk to Renaud Laplanche from Lending Club about what that means, the implications of it, and the future of the company. So welcome, Renaud Laplanche.
Thanks for coming.
Thank you for having me.
So let's go back to 2006. You just sold a company to Oracle. The Valley was sort of still reeling from, post-bubble, the aftermath. Why did you decide to start another company?
Well, it feels like I didn't decide to start a company. What I really decided to do was go on vacation. And we left with my wife and in what was supposed to be a 6-month sabbatical, really traveling in Europe and visiting family and friends.
As you should do after you sell a company.
Right, yeah, that's what you want to do. And about 2 weeks into that 6-month sabbatical, I got the idea of Lending Club, and I started being obsessed about the idea and working late at night, and so my wife put me back on the plane to Palo Alto.
Only lasted for 2 weeks.
That's right.
Yeah. So what sort of brought out this idea?
Yeah, so I got the idea for Lending Club really the first time I paid attention to a credit card statement, probably because I was on vacation, I had too much time on my hands, and I found out that if I was going to carry over the balance to the next month, I would be paying 18% interest rate, which I thought was a really high interest rate. And the same day I was opening up my savings account statement, and I was earning less than 1% from the same bank. So it felt like a big spread between the 1% I was earning on my savings and the 18% the bank was going to charge for what seems to be the same money just going through the banking system and back to me.
So once you had this idea, how did you go about then raising money, and what were the challenges? I mean, as I mentioned before, it was still sort of post-bubble. Were people excited about, you taking on, the financial services industry?
Yeah, so I think there was a fair amount of skepticism initially, and especially from people within the financial industry. The idea of sort of shortcutting the banks and really sort of going around the banks and establishing a marketplace for credit was a very disrupting idea. And even for the general public, I think the idea of lending money to strangers on the internet wasn't particularly attractive, and became even less attractive in 2008 when all these sort of headlines started popping up around people defaulting on their mortgage.
Who put the first money in?
So I did. I reinvested some of the proceeds of the sale of my previous company, and the investors who invested in my previous company also invested in Lending Club.
Was it an uphill climb to try and convince VCs that this was really the future of where lending was going?
Yeah, I think it was. It was for the first few months, at least, when we sort of put the prototype together and we started getting validation from the regulators. At least there was a sense that it was possible. We still had to convince the VCs that we would gain mass adoption, and that took several years, really.
Well, yeah, I'm really curious. You talked a little bit about 2008, the economy. You guys are just starting to pick up steam, and then of course, the economy bottoms out. And then you had some serious issues with the SEC. They almost shut you guys down. Yeah, what was your thinking at that time?
Yeah, so I don't know if it was issues really, but it was part of the sort of creative process. When you run a sort of regulated business, it's a different creative process than other types of technology companies. So for Lending Club, we're really at the crossroads of technology and financial services, and there was all the issues and hurdles you expect with sort of creating a technology that has never been put together before and a process that was entirely new and all the adoption issue you can think of. But in addition to that, there was the regulatory hurdle of really sort of creating a type of securities that had never been registered with the SEC before. So we actually were very proactive with regulators and with the SEC in particular, and really went to Washington and sat down with them and said, okay, this is what we're trying to do. What do you think? And it was a very, I think, productive process, and we had several ideas of how peer-to-peer lending, how a marketplace for credit could fit within the 1934 Securities Act.
Right.
It wasn't a natural fit, but I think we were able to create a legal framework that would allow us to operate and really gave birth to an entire industry. I was at the Lendit conference yesterday, and there are now over 50 companies just in the US and over 200 in the world, really sort of building up on the same model of a marketplace for consumer credit or small business credit.
I mean, it's easy to talk about that time now, as you guys are like the obvious leader in the P2P marketplace space. But, you know, at that moment, I mean, did you feel like, was there ever a moment where you thought, you know, this is so hard, regulators are really pushing back, is it, you know, should I walk away?
No. No, I mean, it was hard for sure, and there was no guarantee that we'd sort of get out on the other side of the, sort of, especially of the registration process with the SEC, where, to your point, we pretty much shut down. So we were on a hiatus for several months. It was a 6-month process. And again, that type of registration had never been done before. So there was really no guarantee we could get it done. But I think everybody in the team was maybe naive enough to think that it could be done, and we got it done.
Well, I mean, now, you know, startups going against regulators is quite common. If you look at Uber and Airbnb, and if you know, you guys did this a little bit earlier. If you had to give, you know, let's say Airbnb CEO Brian Chesky any advice now on dealing with regulators, what would that be?
So I think what worked for us was really to be very open with regulators and very proactive, and really sort of try to make them part of the team and look for a solution. And I think with every regulatory agency in the US, there are sort of two sort of groups of people. There are the folks who are really sort of in charge of enforcing the rules, and the folks who work on policy issues. And if you go talk to the policy folks and show them the benefits to the consumers, whether it's more affordable credit in our case, or more affordable sort of housing solution in the case of Airbnb, more choices, more transparent marketplace. So there are a number of consumer benefits that marketplaces like Lending Club, like Airbnb can bring, and I think regulators are very sensitive to that, because at the end of the day, that's what they also what they want. They want consumers to have more choices and better products and better service.
You're a lawyer, so by training, ex-lawyer. How does that help you in what you're doing right now, and especially considering the regulatory issues?
I think so. Yeah, when you can run a startup in a regulatory in a regulated space, certainly having been on the other side, having been a lawyer and having had a lot of discussions with regulators and sort of all that experience is definitely helpful.
I mean, no offense to lawyers, like my husband's a lawyer, but you know, they're not known as the most like innovative, you know, out-of-the-box type of people. I mean, they get a bad rap in Silicon Valley a little bit. I mean, what do you think? You actually worked at a law firm before Lending.
Yeah, no, I worked at a law firm for 6 years, and you know, I mean, there are many different types of lawyers, and certainly some are more creative than others, and yeah, you find in every profession. I mean, you find people who are passionate about innovation and are not satisfied with the status quo, and always trying to find new ways and better ways of doing things.
So once you were past this sort of SEC hurdle and you were able to iron those things out, was there like an aha moment where things just started to come together and really things just really picked up steam?
Well, I think it's been a slow build-up, but mostly by design. I mean, we didn't try to step on the gas pedal from day one. I think with credit, time plays an important role, and you need to sort of see how every vintage of loans perform for a certain period of time. So we did a lot of testing. I mean, it's really part of the Lending Club culture to sort of test and learn. So we've developed several models and several underwriting models, several pricing models that by the end of 2009 really made us confident enough that we had the right acquisition channels, the right underwriting, the right pricing, and could really start pouring sort of gas on the fire. And so since then, we've been sort of more than doubling every year.
Who are your lenders? I mean, that's sort of the interesting change now, because you actually have a lot of institutional lenders. It's not just, me putting in money for you to then borrow. It's, hedge funds, it's mutual funds. And when did that start picking up?
So I think about 2 to 3 years ago, we started to have enough of a track record to really be appealing for institutional investors. And look, we're a marketplace, right? So we have sort of investors and borrowers. And within each category, there's a lot of diversity. So within the investor side, we have individual investors and institutional investors. We also have banks now that are investing on the platform, which you could see as being ironic, because it all started as a bank disintermediation play. But when you think about it, it makes a lot of sense. And our vision is really to transform the banking system, but we want to do this in a way that associates the banks to the transformation and in a constructive way. And what a online marketplace has going for it is a really low operating cost. We don't have the branches of the banks. We don't have. We have a fraction of the employees.
So
we use technology.
Lean. It's a very lean organization.
Yeah, we use technology and data to lower cost and provide a better experience. We have a low operating cost. What the banks have is a low cost of capital. So when you put together a low cost of operation and a low cost of capital together, you can really generate the best possible savings and the best possible experience for consumers.
With some of these banks, these hedge funds, these other sort of investment institutions that are now becoming the lenders, are you afraid? I mean, these investors can be fickle. They can kind of pull out right away. And are you afraid that if something goes wrong, the economy starts bottoming out, that they're going to leave?
Yes, very much so. So we really don't have a lot of hedge funds as investors. The type of institutional investors we have tend to be stable, long-term minded investors, pension funds, corporate pension plans, insurance companies. So they tend to not overreact to sort of daily or monthly variations and have more of a sort of 5 to 10 years horizon. But still, it's very important to us to build a very sustainable ecosystem and have a lot of diversity within our funding sources, and preferably have funding sources that are uncorrelated to each other. And we believe that individual investors would react differently in different rates environment or in different economic environments than pension plans or insurance companies or banks. So I think that diversity plays very much in our favor, and we're more diversified in terms of funding sources than any other sort of personal specialty finance company or bank or any other lender out there. So that's really part of the power of the marketplace, is to have such a diversity of participants.
You mentioned the banks and how they're sort of partnering now with you. But there's this space is getting a lot of attention. I mean, you've gotten some funding recently. Your other competitor, Prosper, also recently raised funding. you have to think that maybe some of these banks are thinking about you as a potential acquisition target. And have you, I mean, I understand you probably can't say names, but have you had acquisition interest?
Yeah, a lot of interest from the banks, but we, I think we believe we can deliver more value and as a sort of independent company, and really sort of continue to build up the marketplace. And I think we've just scratched the surface of really what can be achieved. We really believe that we have an opportunity to transform the entire banking system. And I mean, we've grown sort of loan originations from 800 million in 2012 to 2 billion in 2013, and we'll continue to grow at the same pace. So it feels like big numbers, but it's really barely scratching the surface in terms of the sort of volume of origination and really how helpful we can be to consumers and businesses. When you think of the consumer credit industry in the US, it's $2.7 trillion outside of mortgages, and then there's another $11 trillion in mortgages. So 2 billion is actually a small number in our industry.
Does staying independent mean becoming a public company?
I think so. I think there's really a strong benefit for Lending Club in so becoming a public company and really signaling to the market that we're here to stay and we're building a very big company and it's going to take a very long time. I think for any consumer-facing company, there's definitely a brand benefit. An IPO can be a really good awareness-building event, and that's how we're thinking about it.
You just raised a new round of funding. You had a lot of mutual funds and some other sort of different investors, not the traditional VCs. And potentially this is the last round before you do, go public. What was your thought process during raising this round, and why did you raise a round versus just, getting your S1 out the door?
Mm-hmm, yeah. So this particular round was really put together in the context of an acquisition that we just made a couple of weeks ago. We acquired a company up in Boston called Springstone that provides patient financing for elective medical procedures and tuition financing for schools. So it's really mostly helping sort of parents pay for school tuition or for sort of braces for kids, so this kind of elective procedures. And the company has 14,000 schools and dental care providers they work with. So it was a great way for us to really increase our reach and get sort of new products, additional data, and additional distribution channels. But it came at a price of $140 million. So we did not have $140 million. So really we went out and raised equity and debt to finance the acquisition.
So you're moving to that vertical. What about subprime? Is that, there is a lot of opportunity there and you're seeing some startups go after that market. Would you ever go after that market?
No, so we really have no interest in going after that market. Really, we're focusing on providing more sort of affordable credit to responsible borrowers. And we think that that's where we can add the most value. Some companies are doing some really interesting things and trying to make the subprime market or even the payday lending market more consumer friendly. But that's not the market we're interested in.
You have some pretty impressive board members. Former Morgan Stanley CEO John Mack, former Secretary of Treasury Larry Summers. How have they helped you, and how did you even recruit them to your board? I mean, was there just automatic interest from their side? Did someone match you?
Yeah, so we've built a great board, and it's a board that works really well together. I think we have a lot of personalities on the board. They're very complementary to each other. So Mary Meeker, for example, has seen so many sort of technology and internet companies getting created. There's a lot of experience there. John Mack has amazing leadership capabilities.
How did you meet John Mack and Larry?
Mary Meeker obviously was the internet analyst at Morgan Stanley. So, sorry. So Mary came on the board at the time of the investment from Kleiner Perkins, and she introduced us to John. Larry Summers bring another dimension in terms of sort of being an economist and also having a sense of how sort of Washington would sort of see what we do and react to our set of products and services. And he was introduced to me by Sheryl Sandberg, who sort of worked for Larry at some point at the World Bank and then at the Treasury.
You also have Google as an investor, which is, I mean, where did that come from? How did that happen?
Yeah, so we have a great relationship with Google. I think there's a lot of similarities in the culture and what we're trying to achieve. I think Google did an amazing job at really sort of disintermediating the advertising market and putting users and particularly small business owners back in the driver's seat and really empowering users, and through disintermediation, through technology, made the advertising a lot more efficient and more of a meritocracy than it used to be, and much less opaque. So we're trying to do exactly the same thing in banking and really put consumers and small business owners back in the driver's seat for more data, more transparency, and use technology to lower cost and generate a better experience.
So, you know, you've been doing this now. You've gone after a huge industry, financial services. It's almost, 10 years old, your company. What's your, parting advice for the entrepreneurs out there who are, now going to be taking on some other large industries like education or health that have yet to be disrupted fully?
Yeah, so we started Lending Club about 7 years ago, so it's not quite 10 years yet. But I think I think perseverance is really a virtue when you're an entrepreneur, and especially when you're going after a very big market and you're doing something that's never been done before. Sometimes it's an overnight success, but sometimes it's not. And I think we've really struggled for the first few years before seeing really the kind of adoption we've seen in the last 3 or 4 years. So I think patience and perseverance are really two virtues that are sometimes very much needed when you start something and you want to really sort of, again, do something that's never been done before. It takes time for sort of adoption to kick in and for market participants to really realize that there is a lot of value there and it can be transformative.
Well, Renaud, thank you so much for joining us.
All right, thank you.